Rising rates and falling prices for bonds as well as equities has been the theme or the story for 2022, and September was no different. I think there was one piece of information that was positive from the month of September was that inflation might have peaked, and that'll probably give the central bankers a reason to at least slow down the pace of future rate hikes. Greetings, viewers. You're watching Aman Sanga, independent financial advisor in Mississauga, Ontario. For my update for the month of September, I will focus on three key points. We'll start with, as always, with the index returns, and then focus on the main data points that came out first from the US and then in Canada. So without further ado, let's get started. If you look at the numbers here, it's been a month to forget. If you were in NASDAQ, it was down about more than 30%, a little bit more. And then the surprising part, the bonds, which have been deeply hit because of the rising rates, they're also in the bear market territory. With that, we'll move on to the next main point about what happened in the last few weeks. And the main thing that was the Fed kept up with the increase in rates, and they have an indication that there'll probably be an end point about 4.6%. That's where they'll likely stop, probably in 2023. Now the markets have already reacted to that news that's been priced in. But the bigger always question is, what does this mean? Is a recession imminent? Now, despite those rate hike, the rise in the federal funds rate, the most commonly used or most reliably believed to predictor of inflation is the 10-year, 3-month yield curve. And that curve still continues to be positive as of October 1st. It is 0.5. So it's still in positive territory. So at least as per the 10-year, 3-month yield curve, a recession is not imminent as yet. Now, if we move on to the last point, which is related to these rising rates, and if you follow the discounted cash flow methodology, this data is from Professor Damodharan's website. You will use these numbers as input to your cash valuation. You can see that the equity risk premium for stocks has jumped, and so has the T-bond rate. So the expected return on stocks for next year is expected to be about 10%. Now, based on which camp you are in, whether you're an optimist, you might think that's a good entry point. And if you are more careful, you might want to weigh your options as to which way the wind blows from here. With that, I'll move on to what I think was the good news from the month of September. This data is specific to Canada, and what we saw is that the inflation has started to come down. Now, albeit 7% is still a lot higher than the desired target inflation for the Bank of Canada. It'll be about 2%, but at least that's the reason to, if not take a pause, at least slow down the rate of future increases. So the central bank will have a good reason, something to smile about, given that we've had such a steep increase in such a short period of time. And lastly, the Canadian economy, despite all this increase in the rates, in my last update, I talked about the job losses. It's still resilient. It's been still increasing at a small, teeny, minuscule percentage growth rate, and still not dipped into a negative growth territory. So that to me is good news. Today, as I record this on October 1st, the markets have been green, and I don't want to extrapolate it, but hopefully that is the trend that continues, or that's the trend on which we can end the last quarter of this year. Meantime, if you've been sitting on the sidelines, you're looking at ideas about entering the market, diversifying your existing portfolio, or just any discussion around financial planning, you know the number to call: 905-363-5035. Thank you so much for watching, and bye for now.